Morning, everyone. Thank you very much for joining us. Hopefully you can hear me and more importantly, see David and hear him once he starts to speak. If not, please flag it in the chat function and we will run around in circles trying to sort the technical issues as is sometimes required. So welcome everyone. Thanks for joining us for another K. Johnson G seminar as part of our helping you build a better business approach. I'm delighted to say that we're joined this morning, as you can see on the screen, hopefully, by David Miller. Morning, David.
Morning, Stephen.
Just testing.
Morning, everyone.
Testing your audio there, David. Good morning, David. David is with, as we can see on the screen, the Customs People. The Customs People is an organisation that K. Johnson G have worked with their further clients for many years. I think David said to me earlier, too many to mention. So that's been a good relationship, and hence this morning's presentation by David. Most of us, of course, are sick and tired of hearing about Brexit. One of the only upsides of the horrific pandemic was we started talking about something else after years and years of non-stop Brexit chat. But this morning's seminar is on the very important and topical and relevant to business area of trading, import and export activities. If there's any questions as we go through, if you want to, you can bludgeon into the call if that's possible. I don't know if it is set up that way, but you can if you want. But more likely, type a question into the Q&A or the chat function, and David will pick it up, or if not, I'll sweep it up at the end, and we'll deal with questions at the end. Over to you, David.
Yes, thank you, Stephen. Say good morning, everyone. Yeah, we've the dual sort of thing of COVID and meant that Brexit kind of wasn't front and centre for some time. But purposes of this morning's session, we're now 4 months into a post-Brexit environment. And I was just saying to Stephen earlier on that my working life in the last 2 or 3 years has very much been focused on Brexit and helping businesses plan for Brexit in the run-up to the 1st of January 2021. And since then, quite frankly, dealing with the fallout from the trade deal that the government signed with the EU on Christmas Eve 2020, and the chaos that's kind of ensued from leaving the EU and the actual terms of the deal. So without further ado, what I'll do is start, if we can move over, Richard's going to control the slides, so on to the first slide. It's not really death by PowerPoint, I don't do that, I really just have some trigger points that hopefully you can take away and mull over. But to recap, going back to January 2020, which seems a long time ago, the UK actually left the EU on the 29th of January 2020. We then entered a transition period in terms of how we traded with the EU from a customs and VAT perspective. So there are, as well as customs matters to consider, international VAT. That ended on the 31st of December 2020. We've spent most of last year really with two things. The first one was business as usual up until the 31st of December 2020. So we still operated under the single market, we still operated under the customs union. That all came to a crashing end on 11 o'clock on the 31st of December, whereupon we entered the brave new world of no longer being part of the EU. We left the EU customs union and we left the single market. So everything that we knew for the previous 28 years changed. So what we'll do is reflect what those changes are and some of the practical things. So some of it may be things that you've heard and kind of already considering, and then we'll look at some of the challenges that has presented itself because of the actual trade deal, and by virtue of the UK now being a third country to the EU, not a third world country as some people have said, but a third country. As I say, the UK-EU Trade Cooperation Agreement is now in operation. It was actually ratified formally by the EU last week, but we've been working under its terms since the 1st of January. And in essence, that deals with all sorts of things, but from the purpose of trading goods, it actually deals with whether duty is due. That's the primary function or primary consideration for today. So if we can move on to the next slide, Richard, please. Thank you. Now, there's kind of two elements really to the post-Brexit environment, and the first one actually is applicable and always was applicable, and say this is where we were looking at flat planning prior to the 1st of January. So irrespective of the trade deal and actually the duty position, which say we'll come on to shortly. One of the main changes is that where for the previous 28 years when the single market came in, because the single market has been in place since 1992, 93. And as if we recall those halcyon days, it meant that any movement of goods from the UK to the EU and vice versa could be done on commercial documentation. There was no need to worry about any customs matters. The whole point of the customs union is once goods are cleared, once goods are cleared from a non-EU country, the customs cleared, they can then move freely around the EU, or they could just be traded between EU member states with no customs formalities at all. That came to an end. So now, if we want to move goods into and out of the UK, there is a customs consideration. So from a cost perspective, we've got additional costs because we have formal paperwork to consider, and we have to think a little bit more about how we move goods in and out. It's not really been helpful on a practical level that despite sort of 3.5 years of actual sort of knowing that we were leaving the EU at some point, unfortunately, quite a lot of the forwarders, transport companies, couriers, carriers, haven't exactly covered themselves in glory in terms of the movement of goods, particularly from an export perspective. And I'll come on to that a little bit more in a minute. But really, one of the first practical considerations we do have is consider whether you're exporting out of the UK to the EU or whether you're importing from an EU country. Consider the paperwork. What do we actually need in order to successfully move goods into or out of the country? If you take that on and say, look at the next slide, what we would say is from an import perspective, I'll cover both imports and exports. From an import perspective, one key consideration that I talk to business about is understanding your supply chain. Bearing in mind, if we're moving goods across border, which we now have a sort of an invisible line from a customs perspective, that either down the English Channel or down the North Sea or down the Irish Sea. I'll touch briefly on Northern Ireland, the fun and games, which is Northern Ireland shortly, but it's understanding your supply chain. Whilst we might have an import into the UK, conversely, suppliers who are supplying to UK businesses will have an export out of Europe. And one of the common themes that I'm finding when I'm talking to businesses is that on the European side, the EU are even less, how should we say, I say considerate, but they considered Brexit to some degree even less than some UK businesses. So when I say understand the supply chain, one key thing is what terms do we buy on? Historically, in buying goods from the EU and bringing goods into the EU, it was really a question of incoterms, so where risk and title pass, was kind of less important from a customs perspective because there were no customs formalities, of course. So the key question tended to be, well, are you going to deliver to me or am I going to collect? So X works, I'm going to collect. The term deliver duty paid is a bit of a misnomer pre-Brexit because there was no duty involved. but if you deliver to me, that's kind of DDP. The incoterms now sort of need to be considered a bit more fully in terms of who is actually going to do what. The reason being the incoterms. So if we're buying on a deliver duty paid basis, which a lot of UK businesses say, well, I'd rather like to do that because I then haven't got to get involved in the import process. Actually, then means that your supplier in the EU has to be responsible for doing customs clearance, is the importer of record, and all the compliance that that entails, which most EU businesses wouldn't want to touch, wouldn't want to touch in a million years. There are some businesses out there, for example, Aldi and Lidl, who actually impose on their suppliers and say, well, if you want to supply to us in the UK, you will supply deliver duty paid, so you will get involved in actually being the importer of record, having a VAT registration, having a euro number, things like that. So, I mean, we're working with businesses overseas, EU businesses that are doing that, but most EU suppliers won't particularly want to do that because it involves hassle, aggravation, and compliance and administration that they're not used to being involved with. So it's likely they'll say, well, okay, we might deliver on a basis where we'll still deliver to you, but you, as a UK business, you're already VAT registered in the UK. You're likely to have an EORI number, an EORI number. The government were actually issuing these rather indiscriminately last year to UK businesses, so you could import and export. But we'd rather like you to be the importer of record because you're based in the UK. So with that comes a number of considerations. The government has, at this stage, given people a choice of either doing full import declarations before goods arrive, which basically says, okay, in order to get goods into the country, you need to have an import declaration lodged at the port of entry, be that Dover, be that Felixstowe, wherever, and that requires certain information. Or what the government have done as an easement, and they've just extended this to the 1st of January 2022, they've said, well, rather than have long queues at the ports coming in, what we'll do is allow you to make what they call delayed declarations. So you can actually bring your goods in just by using your EORI number. You don't need to lodge any kind of declaration at the point of import, but you've got 6 months from the point at the date of import then to arrange for the declaration to be made. Now, what that will involve is providing certain key pieces of information, whether it's a full declaration or a delayed declaration, providing key pieces of information to your freight forwarders. Now, that will include things like commodity codes. You might have heard the term tariff heading, HS codes, commodity codes, but effectively every product that's imported into the UK needs to have a commodity code assigned against it, because that then determines what percentage of duty could be payable. Even if zero duty is paid, is what duty could be payable. There also needs to be a value assigned. So typically, if you're buying goods from a supplier, it will be your commercial invoice from your supplier. And then whether or not there's any duty mitigation or any reliefs are being claimed, that they need to be communicated to the freight forwarder. So it's worth familiarising what those requirements are, because if you don't provide those to the person who's doing the clearance, be it one of the couriers or be it a freight agent, your goods won't be going anywhere unless you use delayed declarations, but then you've got the compliance of making sure that's declared within 6 months. The other big consideration for, and I'll come on to the trade deal and claiming zero duty later, but the other consideration is what the government also introduced was a thing called postponed VAT accounting, whereby usually prior to Brexit, if you imported goods into the UK from non-EU countries, as they would have been then, you had to pay the import VAT on arrival of the goods. You then claim those back, that VAT back, assuming you're fully taxable and you're entitled to claim recover VAT on purchases. So there was a cash flow consequence. What the government decided to do, though, because the number of declarations pre-Brexit rose from 55 million a year to 255 million a year post-Brexit. Trade sort of made representations to the government and said, well, actually, if we've got to pay import VAT up front and wait to claim it back, it's going to absolutely cripple the economy on cash flow. So what the government did was introduce the option of using postponed VAT accounting, which basically says, rather than declare and pay import VAT and then wait to claim it back, your import VAT can be declared on your VAT return. So migrate to your VAT return and you can claim it back on your VAT return. So from a cash flow perspective, it's neutral. And that applies to any imports from anywhere in the world. So they've actually sort of extended it to non-EU imports as well. One of the practical considerations we're finding, though, is that if you want to use postponed VAT accounting, you need to inform your freight forwarder clearance agents proactively. They will only, what we're finding in practice is that the clearance agents will only actually use postponed VAT accounting if you've specifically instructed them to. If they don't, they will still collect the import VAT, pay it over to HMRC, charge you for it, and you'll get the VAT. You'll then have to wait to get your C79 certificate and wait for your VAT return. In terms of calculating postponed VAT accounting, what HMRC are doing is issuing statements monthly and saying, okay, here is what you owe. And please put that in your VAT return. The slight disconnect is if you actually use delayed declarations, you wait the full 6 months to lodge the customs declaration that gives the details of what duty and VAT is due, that won't appear on your postponed VAT accounting statement until you've actually lodged the customs declaration. However, just to complicate things, what HMRC has said on that side is, but we want the import VAT accounting for in the VAT period where you actually did the import. So, and if you haven't done the import declaration by the time the VAT return is due, so let's say you did an import in the quarter to March 2021, but don't do the delayed declaration until July 2021, the VAT is still due on your March VAT return, but you won't actually know exactly how much that is until July when you do the declaration. What HMRC is very helpful at saying is, well, you can estimate that import VAT and adjust it later, at which point most finance people just throw their hands up in horror and say, oh my goodness, we don't want to do that. So there is a timing thing to consider on delayed declarations. So that's some of the practical considerations around imports, but as I say, it's understanding your supply chain so things run smoothly. If we move on to exports, so the next slide, if that's okay, please, Richard. Okay, again, where we're doing a lot of work and talking a lot to business as well as imports is looking at exports. If you're selling goods to EU businesses and goods moving to the EU, again, the starting point is understanding your supply chain. What are the incoterms you want to work with? What we're typically finding, I've been working a lot with businesses, is sort of the message or the pushbacks that UK businesses are having from European customers. Some clients, some businesses say to me, well, actually, we kind of want to be proactive and kind of make life easy for our customers. A lot of our customers have never had to import before. All their trading has been with the other EU businesses. I mean, I'm dealing with a couple of businesses, two businesses, one in the pharmaceutical business and one a boiler manufacturing business. The Brexit sort of impact was that both businesses, their international trade, shall we say, was purely with the EU. So prior to Brexit, their sort of international profile of importing and exporting was something like 1% of their turnover. One of them, I think, their actual sort of purchase profile was, I think, they spent £1 million a year buying equipment from China. Yet their actual spend with EU business is about 150 million euros. So they've actually gone from a purchase profile of 1% being sort of imports and having to worry about customs to now 94% of their business is involved or purchase, moving goods where customs are involved. So it's throwing up some real, Brexit's throwing up some real sort of major changes to some businesses. But from an export point of view, it's understanding your supply chain. So some businesses are saying, well, actually, we want to be proactive and go out and sort of not give our customers any reason not to buy from us. And we can see that businesses in Europe that aren't used to importing need us to do that for them. Or some, as I mentioned, some EU businesses are saying to UK customers, UK suppliers, look, actually, we're imposing on you, you must apply to us DDP. So deliver duty paid, you will actually send out goods that we're buying from you, and you'll take care of importing into the EU. You'll take care of compliance in terms of VAT and taking care of any duty that might be payable. So sort of understanding the supply chain is talking really to customers and sort of agreeing between what terms do you want to buy from. The alternatives, which include deliver at place, is basically you'll still deliver to their premises, but they will be the importer of record, and that they'll pay any duty and VAT that's payable. And again, where we're getting sort of the conversation, should we say, oh, well, okay, who's going to do what, and how does that affect things like costings? Because if duty is payable on goods going into the EU, and I'll give some examples a bit later when we look at the trade deal, who's going to actually pay that cost, and how does that affect your pricing? Unfortunately, the trade deal isn't what we thought it would be. As I say, we'll come on to that a little bit more in a minute. So it's kind of, understanding what's going to happen. Again, a lot of discussions I've been having with UK businesses that are exporting to Europe, particularly where it's DDP. So, not only are you exporting from the UK, but you're importing into Europe, involve actually, how do we do that? I'll just mention that in a second. Exporting from the UK does now require, so it's irrespective of incoterms, does require an export declaration being lodged. So similar information to an import declaration, you need a commodity code, you need a value, instructions to a clearance agent. Unlike imports, there is no facility for delayed declarations. Basically, if you haven't got an export declaration pre-lodged with HMRC prior to goods arriving at the port, your goods ain't going anywhere. I've had situations where a month or so ago, a business contacted me and said, we've tried export. We've got a wagon on its way. It's now on the M2 on its way to Dover to leave, but HMRC systems rejected our declaration. What do we do? It transpired. A little quirk of the system was that the exporting couple, there was a VAT group, which included a number of companies. What the business didn't realise, and it's a bit of an anomaly, is that whilst you might have a VAT group, every company needs its own EORI number, because for customs purposes, there is no such thing as a group. Every business has its own EORI number. And what they've done is they've actually given the EORI number for the representative member of the VAT group, which didn't match the actual export paperwork, which actually said the exporting company, and there was a disconnect. And it transpired. I mean, we sorted out in terms of what paperwork needed to be done with the right details, but effectively the wagon had to go back to base and start out the following day. So, again, it's thinking through the paperwork, making sure the paperwork's there, and really before any transport occurs, the paperwork's accepted, is pre-lodged. And as I say, anything turning up at the port without customs export paperwork ain't going to go anywhere. So it's worth just considering that. In terms of looking at DDP, what a couple of sort of brief examples of that. And again, this is sort of over and above the trade deal itself. On a practical basis, where we're sort of playing with businesses is, if you want to do an export to the EU and import into the EU, what we're quite often doing is looking at strategic planning and saying, well, okay, if we're going to import into the EU, where should we import? Because you might have customers in all 27 other member states. Well, clearly you don't want to get involved in importing into 27 different member states and having 27 EU VAT registration and dealing with 27 different customs authorities. So what we're typically doing is saying, well, actually, where are you shipping to, which countries do you first touch, and typically that's either the Netherlands, Belgium or France, and actually route all the shipments through one or two of those countries, do the customs clearance in that country, becomes that registered in that country, and then in effect just hub all of your shipments. What it does is it means that strategically you're doing, if you want to supply DDP, you're paring it down to how many different authorities you deal with. The Netherlands, France and Belgium all have some quite cute ways of working in terms of VAT, in that, okay, customs clearance will take place and duty will be payable, but VAT, they've all got an equivalent of postponed VAT accounting. So even import VAT doesn't become a cash flow cost, and then sales or supplies out of that country become intra-EU movements. So if you're shipping, say, to Germany, to a German customer, typically you could customs clear in the Netherlands, pay any duty that might be payable, make the customs declaration, import VAT goes on your VAT return, and then the actual supply from the Netherlands to Germany is an intra-EU supply, so no VAT. So VAT kind of washes through, but it just means that in that respect, it is just setting it up and putting those things in place. And say we're working quite a lot with people to do that. So if you're exporting to the EU, it's worth thinking around, well, actually, how do we want to do this? How do we make it so that we get the customers sweet and don't give them a reason for not dealing with the UK? And how also do we actually manage it so as the least disruption on our supply chain? Make no bones about it, Brexit has added a level of complexity we never had to deal with previously. But unfortunately, some people say, well, when's it going to change? Well, it's not. Even if the trade deal changes anyway, it's not that how we do things is going to change. So it's a fact of life. But some real sort of strong, how should we say, messages to take away in terms of, right, how do we do it? And the EU the EU countries like France, Belgium, and the Netherlands are geared up for this, and we're getting used to it. If we turn to the trade deal, we just have a mosey through the trade deal. I'll be quite honest, and I've been rather grumpy for the last 4 months, because when we actually sat down, there's a very big disconnect between what Prime Minister Johnson actually said on steps number 10 on the 24th of December, saying that we've got the deal done, we've got our up and ready, a fantastic trade deal in place, and we're good to go on the 1st of January. Number of quick takeaways on that. Number one, it didn't really give people time to plan in the way that they could, and that really want to plan, and a lot of planning is still going on. And number two, it is anything but the trade deal that we thought we were going to get. In actually, quite frankly, it's a ridiculous deal in terms of what it means. At the very best, it's complicated and complex. So dealing with Europe is on a duty-free basis isn't as straightforward as we thought it could be. So at the very best, it's complicated. At the very least, it's not a trade deal at all. So for businesses that buy and sell finished goods, that it's effectively a no deal. And the reason for this is that the actual terms of the trade deal is based on origin of goods. So if we want to trade with Europe on a duty-free basis, so in other words, no duty is payable on our goods going into Europe or on EU goods coming to the UK, the goods have to either be of UK origin for the purposes of exports to Europe, or of EU origin for the purposes of claiming zero duty, claiming preferential rate of 0% coming into the UK. Now, under the actual deal, what that means is to be of UK origin or EU origin, goods need to be subject to a process. So very simply, if we've got a situation of goods are manufactured in the UK using purely UK materials, well, that's fine. Those goods clearly meet the rules of origin of being of UK origin, because it's all UK. If if the materials are solely from UK raw materials and EU raw materials, then there's a concept called accumulation, which means the EU raw materials in manufacturing that product in the UK become treated as being as if they were UK origin goods. Where it becomes complicated is that for each product, for each commodity code, we mentioned commodity codes earlier, there's a rule of origin that actually says, well, in order to be UK or EU origin, if non-EU and UK raw materials are used in the manufacturing process, which quite often they might be. You might be importing raw materials from China or from the US or places like that. There are rules that say, well, okay, in order to be qualify as UK origin, number one has to be a process. So in other words, you need to be adding some value, and there's a list of minimal processes in the trade deal. So things like repackaging wouldn't qualify. So things like that. There has to be some real added value, some real, I think the phrase is significant transformation. But even having undertaken a process, there's then a rule of origin. It's all around how much non-EU/UK raw material can be used in that manufacturing process. And typically, there's two main rules. They're not the only rules, two main rules, but one will be, okay, any non-EU UK materials can be no more than a certain percentage of the final export price. So if I take an example of a business I'm working with up in the northeast, where what they do is they actually send out component parts to Romania, and in Romania they make up garments for my client. So what we've done is we sat down and said, well, okay, where are all those raw materials sourced from that you send out? And we've worked it out and said, well, okay, most of it is either UK or EU sourced material. Is about 20% by value is non-EU and UK materials. And we said, well, okay, we know there's a manufacture going on in Romania, but the actual rule of origin for that garment is that in order for it to be EU origin, and therefore on re-import into the UK, 0% duty, the non-EU UK materials can be no more than 40% of the final price. So we worked it out until actually it's about 20%. So that's fine. Prior to Brexit, of course, they didn't have to do that because they sent stuff out to Romania, got made up, and they brought it back again. There was no customs to worry about. So at the very least, even for things that qualify for origin and for preferential trade, there's a process to go through to say, well, actually, do the goods we're buying or do the goods we're selling meet the rule of origin to be the UK or EU origin? Because if they don't, then duty is payable. I'll give another quick example of the business. They import Argentinian prawns into the UK. They then do quite a substantial process for these prawns before selling them. And one of their markets was the EU, and duty on what they send to the EU, if they don't meet the rules of origin to qualify as UK origin, is 20%. Now, when we actually look at the rules of origin for prawns, in order to qualify as being of UK origin, not only does it have to be a process, but the prawns have to originate in either the EU or the UK. Well, they don't. They're caught in Argentina. So despite the business doing quite a big manufacturing process, when they sell those prawns to the EU customers, their EU customers are now being lumped with a 20% duty charge, which I think we'd all agree isn't really what the purpose of Brexit was about. So there are some anomalies that have been brought up in that respect. If we move on to the next slide, if that's okay, Richard, thank you. So in considering the deal, the first thing is, well, okay, it's not as simple as saying, well, okay, the goods are moving from the UK to the EU, therefore there's no duty. It is all about origin. It's all about saying, well, do our goods meet the rules of origin to be UK origin goods, and vice versa? Are we buying goods which are of EU origin? Again, the business that sends out materials to Romania, they buy a lot of material from a business called Gore in Germany, which is sort of Gore-Tex, that kind of thing. And they've just been lumped with a big duty charge because Gore have said, well, what we sell you isn't of EU origin. Therefore, actually, now when we sell to you, you've now got a 12% duty charge on everything we sell to you. And it's kind of understanding that because, just because things are going cross-border, it is all about origin. If and as I say, I'm spending a lot of time working with businesses in terms of understanding what origin means for their particular products, because it does vary by different sort of product category. If there is preference, what we do have is an added sort of thing is, well, okay, what paperwork do we need to make sure that we claim preference? Because again, part of the process on importing and exporting, be it importing into the UK or importing into Europe, is you have to actually make a claim to pay zero duty. So you actually have to say, well, okay, these goods are of UK origin or of EU origin, therefore no duty should apply. So at import, if we're buying from an EU supplier, we've got two methods of actually evidencing that no duty is payable. The first one is we can obtain a statement of origin from our supplier. They have to be authorised to give that using a REX number, registered exporter number, and if they provide that, we can then claim zero duty being payable by telling our clearance agents, here is our statement of origin, make sure that we claim preference. The second way is through a thing called importer's knowledge. Now, what that's basically saying is we know that the goods are of EU origin. Now, I would really say if you're doing a third-party purchase, you'd always ask for a statement of origin, because whilst you can claim importer's knowledge and claim preference through importer's knowledge, you then have to back it up at a later date with how do you arrive at that. So it's available, but it's kind of, my feeling is with preferences, the government has kind of made it easy, but it's also made it easy for people to fail because they don't really understand when preference documents necessarily can be issued. So it is a case of if you're buying from Europe and you want to claim preference, understanding and getting statements of origin. If you're selling to Europe, your customer will probably want you to issue a statement of origin saying those goods are UK origin. Again, issuing a statement of origin from the UK is a lot easier in that all you need is your EORI number. You don't even need to be authorised to raise a statement of origin. However, I can't help thinking that at some point in the next year or so, HMRC are going to come out and visit people who have been issuing statements of origin or claiming preference and saying, do you know what you're doing? And if not, we'll in all likelihood penalise you. So if preference is something on your radar, it's certainly worth looking into and making sure you understand what the rules are before either claiming preference or issuing statements of origin saying goods are of UK origin. Because as we said, if you bring goods in, I mean, I'll give an example of a business. They bring in certain products and they bring in one product from Switzerland, which all they do is print their logo on and then ship out to Europe. Now, they don't meet the rules of origin for that to be UK origin, because the value that they're adding is by adding their logo, and that isn't sufficient. Yet they've been merely issuing statements of origin saying the goods are of UK origin to their EU customers so that they can claim preference. What I've said to them is, well, HMRC will probably throw the book at you if you carry on doing that, because you're actually issuing a legally false document, and there are penalties for that. So that's kind of an example there. Can we move on? I'm just going to go on to some of the anomalies of the trade deal.
David, just before you move on, there's a question from Alistair in the Q&A. PVA.
Okay.
One. Don't know if you can see it.
I can't actually see it, so I'm glad
just says PVA, once the customs agent is notified that the importer wants to use this system, how does HMRC contact the importer with the VAT due?
There is I think you have to log in through what they call CDS, the Customs Declaration System portal, and register, put your EORI number in and register, and then what they'll do is monthly they'll send you a statement that says, okay, here are all your imports that you've had in this month, and here's the import VAT that you owe and you should put in your VAT return. So they will issue statements. They are doing that. I have seen them, but you have to register on I think it's a CDS portal where that's actually to do that, and then they'll just send that to you every month.
Okay, hopefully that answers it, Alistair. Okay. If not, just shout.
Yeah. Okay. So yeah, if we go forward, Richard, to anomalies now. what the trade deal has done, being rather a rather how should we say rubbish trade deal, let's be quite honest about it. It has thrown up some real anomalies, some of which were going to sound complete bonkers, some of which are just unfortunately it's the outcome of the deal being what it is. So as I mentioned, if you're bringing in finished goods, so the same business that I mentioned that send materials to Romania to be made up, they also bring in what they call traded goods. They bring in finished garments, typically from Thailand, and they have, and this is quite a common thing, they have around about 30% of their trade is EU. What many businesses will do is, they'll bring consignments in from the EU, from non-EU countries, container loads, bring them to the UK, and then the UK is the distribution point for both the UK and the EU. Unfortunately, what that means is when goods come into the UK, unless we do some duty mitigation, UK duty is paid at the UK duty rate, which is actually slightly less than, in some instances, less than the EU rate, but duty is paid on import to the UK. Now, any goods that then go to Europe are then subject to duty again, because you can't issue a statement of origin saying these goods are of UK origin, because if they come to the Far East and you've sold them without any added value, well, they haven't changed in any way to become UK origin goods. So we do have the distinct possibility of double duty being paid into the UK, and then duty on your sales price being paid again by your customer yourselves when the goods are traded into Europe. So there are some mitigation angles, customs warehousing, so putting goods that are coming in that could be going to Europe into a customs warehouse. So again, that's the solution for this business, is they put all their goods into a customs warehouse. Any stays in the UK has UK duty paid on it when they want to use it in the UK. Anything that goes to Europe doesn't have UK duty paid on it, but just has duty paid going into Europe. And we've been working with a few businesses in setting up customs warehouses, either individual businesses having their own customs warehouse facility. We work with a business over in Lincolnshire that brings in swimwear and that kind of thing. And they sort of said, well, 35% of our business is to Europe. We don't have the infrastructure to be able to send direct shipments, the containers directly into Europe. We don't have any logistics over there. We don't have any infrastructure. We can't really split shipments. So what we've done is set them up with a customs warehouse, and it just means that that they can ring fence, or they don't pay duty on anything that's bound for Europe. So it is worth bearing that in mind. If we do have situations like that, I mean, it's worth looking for, make sure there's not double duty. The second one is EU imports. If it gets brought in without any evidence of preference, we've already talked about preference, then duty will be payable. Mitigation is talking to suppliers and seeing whether there is preference available and making sure that claim is made at the point of import. If it's not, you can still go back and make a claim at a later date, but again, it's whether duty is payable on the commodity code. Some products come in zero duty anyway, so preference doesn't matter. But if there are EU imports without that evidence, you will get charged duty. We do have a rather bonkers situation where you may have all heard about Percy. You may have heard about Percy Pig, the M&S sweet that's manufactured in Germany. M&S bring that into the UK, and then they distribute it both into the UK and to Ireland. There is a provision within the EU trade agreement that says, well, if goods leave the EU and come into the UK, or just leave the EU and go to a third country, when they're re-imported, they will have lost their EU status, therefore duty is payable, which seems a bit bonkers. If somebody's paying duty on EU origin goods when they're re-imported into the EU. So there is a relief called return goods relief, which again, it's worth planning, because that basically says, well, if you can show to customs satisfaction that goods that are being imported have been exported from the EU and are the same goods, then duty can be mitigated and import VAT mitigated. The one disconnect we do find is that if you're a UK business, you import goods from the EU, from one supplier and send it to another EU country, how you deal with return goods relief it is interesting, because if you say to your customer you can claim return goods relief, that's all well and good, but they'd have to evidence where those goods left the EU. So you'd probably end up having to give them commercially sensitive information, like your supplier's invoice, which you really don't want to do. So the way around that would be, if you've got goods going into Europe, where duty would be payable because of the trade deal, what we would say is deliver DDP and claim return goods relief on re-import. So all these processes have obviously details around them, but what you might find is, if a customer says to you, well, hold on, I've had to incur duty even though these goods are of EU origin, that's because the way the trade deal's laid out, but there are ways around it. And then the last anomaly we've got is that if you've got goods, and again, I'll give an example, a business I've been working with, they import T-shirts from Pakistan. Pakistan and the UK have a trade deal. Outside of the EU trade deal, it's now the UK-Pakistan, where it's actually a GSP, but it's a trade deal. So on import into the UK, the T-shirts are duty-free. The business then actually screen prints onto the T-shirts and sends them to the EU. Unfortunately, the rules of origin around garments are that if it's a finished garment when it comes to the UK, then whatever you do to it in the UK won't make those garments UK origin. So it means that on re-importing to the importing to the EU, duties payable. We have looked at whether or not a preference can be claimed under the EU trade deal with Pakistan, but in order for that to happen, because preference is all around direct shipments, so in order for that to happen, it's very much a case of you'd have to sort of show that what was sent from Pakistan was going to the EU and there was no processing done in the UK. Unfortunately, screen printing is a process, so this chap sort of ends up between two stools. So if you are buying from, and again, talking about another client who buys goods from Singapore, which end up in Europe, there are some process flows that can take place to try and get that preferential rate of duty being claimed on importing to the EU as well. So the trade deal is not without its anomalies, but again, it comes back to knowing your supply chain and looking at that. Before I move on to the next slide, I think we've got another question. Using MTD on QuickBooks, do I counter import that by using 0% PVA or 20% PVA? What I would say, Alistair, is that the 20% PVA, I think it will be 20% PVA if the goods are standard rated. So I think that the 0% and 20% is based on what is the VAT liability of the import VAT. Now, the VAT liability of import VAT follows what the VAT liability would be in the UK. So, for example, if I'm bringing in adults T-shirts, the PVA would be 20% because they would be subject to 20% import VAT, because if you bought T-shirts in the UK, adult T-shirts, they would be 20% VAT. If I bought children's T-shirts, it would be 0% import VAT under PVA, because if I bought those same items in the UK, it'd be 0%. So that's the distinction. Should we move on to the next slide? There's only a couple left. I'm conscious of time as well. So in terms of sort of conclusions that we can reach, be proactive. I mean, I see a lot of people say, oh, well, how much should I engage with my supplier or my customer? I'd say there's no reason not to be proactive, because many EU businesses see Brexit as a UK problem, and not without some justification, given that we decided to leave the EU, not them kick us out, despite the relations we sometimes have with Europe. So a lot of EU businesses see Brexit as a UK problem. So it's worth being proactive, even if they don't, just to sort of say, how are we going to do this? Who's going to do what? Just to make sure, because if we bear in mind, for every import into the UK, there's an export from Europe, and for every export from the UK, there's an import into Europe. So it's understanding who's going to do what, so that things don't, you've got the best chance of things not being held up. As I say, understand the rules. The government has been, say, helpful in some degree in terms of trying to come up with some simplifications. I can't help thinking they are setting people up for a fall by not understanding the rules. There's an absolute myriad of information on the gov.uk website. I'd probably say in some ways a bit too much, because it really is almost following the breadcrumbs through the enchanted forest to Hansel and Gretel's cottage to get to the right answer. Sometimes it does take a bit of piecing together, but there is loads of information on there. But it is understandable the rules. And without doing the sort of a huge PR job, do take advice. The government currently, up until the end of June, is they are actually have a government grant available for taking professional advice on Brexit, sort of dealing with customs, imports and exports into Europe. So taking advice. They've got a grant for up to £2,000 per company, where you can take professional advice or get training. You can get training in terms of what should we do on custom process, things like that. So they are, and there is a link. It's administered by PwC, but there are grants available for the moment to try and assist help businesses understand. So I think the government have realised that it's not straightforward. A lot of businesses, I kind of say 28 years since the single market came in. Businesses that were in business prior to then have probably all long forgotten how to do this if EU trade was a main international trade. And businesses that are less than that, businesses which have been in business less than that won't understand or would never have dealt with it. So it is a case of understand there is help out there, and the government are allowing grants. I think the last two slides are just who we are and what we're about. And Stephen sort of said earlier, sort of that we've worked with Kate Johnson G for in excess of 15 years. Basically going 25 years, and I've been involved in the field for 30 odd years with colleagues assisting. So I think that's everything. I know it was probably quite a quick recap, quite a quick tippy toe through some of the key points, and hopefully it's been of use. If there are any questions, just let me know. And as Stephen's put on there, that's where I live, and that's my contact details. But if there's any questions, let me know. Otherwise, I hope it was of use.
That's excellent, David. Thank you very much indeed. As everyone can see, David's contact details are there. If for some reason you need to get in touch with David via ourselves, please feel free to do so as well, obviously. But thank you, David. Excellent run through what is a very complicated area, but with a massive profile at the moment, and probably remaining, as you indicate, remaining a massive profile because of the ongoing changes and implementation and so on, that will be the case for the foreseeable future, probably, is the truth of it, as it unravels or ravels, depending on your take on it. So thank you, sir. That was excellent. Thanks also to everyone else for joining us this morning. If anyone wants to, there's no questions now appearing in the Q&A. There's no little electronic hands going up, but if there are any burning questions, please ask them now, by all means, and we'll deal. David will deal with them. I won't, as you know. But thanks everyone for attending. Our next booked seminar is actually a physical event now. Whether we manage, yeah, exactly. That's a good response, David. Whether we manage to do it or not, we shall wait and see. But 13th of July, we're running, hoping to run one of our masterclass events held at Lancashire County Cricket Ground with an excellent speaker, Grant LeBoeuf, who's run a masterclass for us before and is excellent. So we shall see how things develop between now and having to firm up on a 13th of July physical event. But if you're on a mailing list, which you should be, you will receive details as and when. So just to finish up, thank you all very much indeed. Thanks, David, again. And this has been Kay Johnson G helping you build a better business. Take care, everyone.